All right, we're looking at the Jane Johnson case study here on private markets. Let's read the first question. Discuss with two reasons why Jane's firm might prefer private investments over public investments. Each reason should be in a separate paragraph. Let's read a little bit. To be honest, this doesn't seem like we need any information from the reading to answer, but let's read just to make sure there's nothing valuable in here. Jane Johnson, a portfolio manager at a large institutional investment firm, is evaluating the firm's strategy for diversifying its portfolio by increasing its allocation to private markets. The firm currently holds a diversified portfolio of public equities and fixed income securities, but has minimal exposure to private investments. Jane is tasked with presenting a comprehensive analysis to the investment committee covering various aspects of private investments and their integration into the firm's strategic asset allocation. Okay, so there was some good information here. So we know the portfolio is currently public equities and fixed income securities with minimal private exposure. So kind of what are the benefits of adding private investments to this public portfolio? So I've got two here, and then I'll list off a few other ones. But big one, diversification. Some alternatives are going to have lower correlation to stocks and bonds, which is the current portfolio, which could provide diversification benefits, lowering risk without decreasing returns. And then second reason, potentially higher returns. Some alts like private equity and venture capital have historically provided higher returns than public equity markets. Some other reasons you could have put down are less regulatory scrutiny of private markets or of private investments and companies, more control over the underlying investments. In the case of private equity, a lot of times you're buying the whole company or you're a significant investor, whereas if you're buying shares of Microsoft or Apple, you're obviously going to be a pretty small investor in the grand scheme of things. Two more unique assets like real estate and infrastructure. Some of those investments may not be available in the public avenue. And then if you have a long time horizon, capturing that illiquidity premium of private investments could be attractive. Question 2. Explain with two reasons why Jane's firm might be cautious about increasing its allocation to private investments. Each reason should be in a separate paragraph. Let's read a little bit more. We left off here. The investment committee is particularly interested in understanding the key differences between private and public investments, the various methods and structures available for private market investments, performance metrics specific to private investments, and risk-return profile of private versus public markets. All right, I think we have enough information here. So why should we be cautious about increasing to private investments? I think two of the most prominent reasons here. One, illiquidity. Private assets are going to be more illiquid, so increasing allocation may make rebalancing more difficult. If you want to rebalance from private investments into public equities, that's going to be a difficult task because these investments are locked up. And or meeting cash needs could be more difficult. You may be forced to kind of pull from these more liquid sources in times that you don't want to. And then secondly is the complexity. Private assets are typically more complex and require more specific additional investment and operational resources and expertise relative to public markets. A couple of other things with kind of this complexity is higher risk potentially. And, one of the big pitches a lot of the time is private investments is that they're going to diversify relative to your public investments, but they may not diversify in times of stress or liquidity needs. Question 3, based on the case information, identify and explain two private investment methods that Jane could consider for diversifying the firm's portfolio. Justify why each method would be suitable for the firm's strategic goals. So this question is a little difficult, but what they're kind of getting at or looking for is ways that they could allocate to private investments, not necessarily types of private investments themselves. So the two ways that would probably make the most sense for them are co-investment or investing in a fund. The third option would be direct investments, but considering their lack of experience with private investments, that probably doesn't make sense. So co-investment, investing alongside other investors or PE firms that have vetted a deal. This is going to have lower fees than a fund, which will increase long-term net returns, which is a goal of the firm. And then, let's see. I forgot where that was in here, but it did say somewhere that they wanted to increase long-term net returns. And then invest in a fund, invest in a GP who will source and due diligence the deals. This is going to be a good method for them because it will require less internal resources, which may be suitable since the firm currently only is invested in public investments. So they may not have the expertise or bandwidth to kind of do due diligence on individual investments, which would be required under co-investing. Also allows for quicker diversification into more deals, which is a goal of the firm. So those are two reasons, or I guess why co-investing and investing in fund would be better. You probably also could have listed out why direct investments wouldn't be good to kind of further solidify your answer, but probably not necessary. Question 4, calculate the total value to paid in for the potential private equity investment with the data provided, and then interpret this metric for the investment committee's decision. So the total value to paid in, our numerator, total value, is going to be any distributions we've received on our investment, plus any remaining value expected to be distributed in the future. And then to paid in is going to be kind of our denominator or the capital that we committed, and then we'll interpret this metric. So let's read, I think we left off here last. So to assist Jane, the firm's research team has gathered some initial data and information. The firm is considering a potential private equity investment with the following data. Initial capital invested of $500,000, so that's going to be our denominator for here. Distributed proceeds of $300,000, that'll be in our numerator, and remaining value, so this will be our DPI, and then remaining value of the investment portfolio of $400,000. This will be our RVPI. The firm's goal is to achieve higher returns through active management and value creation. The firm aims to diversify its portfolio and reduce overall portfolio volatility by incorporating private market investments. So our calculation here is going to be pretty straightforward. We're going to add the distributions plus what we're expecting to receive in the future, divided by our initial capital. So that's going to give us a multiple of 1.4. So interpretation of that is every $1 that we're putting in is growing to $1.40, creating a 40% return for investors.